Alright. Alright, so let's start. Top is the chart, bottom is the text. So I'm going to start going over it. Alright, so let's start. Where's my. As previous. Get my tongue tied. Anyway, this is the. Before I just start this, this is the trend chart. Trend chart is your market index. So for you, whoever is listening out there, you're gonna use the S&P or the Nasdaq or the Dow. You could also use, if you want to create your own index, you could use a equal weighted index, whatever it is that you use. Just use a market index. So when he talks about the New York Times average of 50 stocks, today it would be like a S&P, right, or Nasdaq. So that's what he's going over in his day. The concepts are exactly the same. Alright, so what's the most important thing to know? Trend. That's the first statement. Since we aim usually to operate in harmony with the trend, a study of a daily trend chart should be the starting point of all our deductions. Here's what you need to know so far. Daily chart. Alright, that's the time frame you're going to look at. And the S&P or the Nasdaq or the Dow or whatever. Alright, daily is the start, not the hourly, not the monthly, the daily. No one has yet devised a perfect average, so just use whatever you usually use, because the correlations are extremely high. Alright, so okay, it is important for you to know this so that you will exercise judgment at all times. Exercise judgment at all times in reading your trend chart. What's important, that there's no one is better than the other, and this is the case today. It was the case then also. You know, that's what he's saying up here. So just the point is, just use a market average. Do not get stuck in a trap where someone says, oh, you got to use the S&P, you got to use the S&P, it's 500 and the Dow is only 30 stocks can be manipulated, so you got to use the S&P, blah blah blah, or the Nasdaq has too many tech, or the S&P has too many banks. Who cares? Just use a common average. Alright, because you're gonna be using the Wyckoff wave later on anyway, so just know that right here he's talking about, for example, S&P. Alright, so you will remember that the deductions you draw from it must frequently adjust or conform to what you see in the behavior of your wave chart, your group chart, and your individual stocks. What he's saying is, you use all of them together to have a judgment about direction. You don't use any in isolation. However, we will start with one market, and like the S&P, and then move into the others. Wave chart, group chart, or 50 stocks or whatever. Alright, subject to the above qualifications, you will find the times good enough, and the rest is, if necessary, you can make your own average. I don't recommend that unless you have the software, because there's not a lot of software that allows you to create your own index, but there's software out there that does allow you to do that. I think even Thinkorswim allows you to kind of like add symbols. Like, if you do a FANG index, Facebook, Apple, Netflix, Google, it'll actually allow you to add the symbols together. Regardless of whatever you use, just use something. The accompanying chart includes the total volume of transactions. Okay. So it's just a bar chart with volume. Okay, so here's we start looking at the behavior. We use the period from December 8th to December 17th as a starting point, and without regard to the market history previously recorded. This interval of 9 days marks a sharp acceleration of the previous decline. He's talking about, now I'm going to go to the top, so I'm going to go back and forth between the text and the chart. He's talking about these 9 bars, 1, 2, 3, 4, 5, 6, 7, 8, around 8 bars right here. So he's talking about this, all right? What is he saying? He's saying sharp acceleration. It's going down with a lot of speed. It's going down. All right, 1 second. All right, I'm back. The story told is that there's an acceleration downward. Okay, now what he's not saying here is that there's history in the background, and there must have been multiple waves. Okay, there's multiple waves in the background, and this wave or this swing down is accelerating, and it's accelerating more than the others. Okay, or at least more than most of the other swings down. So the story told by this chart is that he's not looking at the market history, but it's already in a downtrend. The interval of about 9 days marks a sharp acceleration of the previous decline. So it's sharp. The acceleration is sharp. There's a lot of speed. There's a lot of price progress to the downside, culminating in widespread of the daily price ranges and a very marked expansion in the daily volume of trading as the market reaches its low, thus reflecting panic selling, which takes place under such conditions. Alright? So all he's saying is basically this is a selling climax. This is what you all know as a selling climax. It's a big move, as evidenced by the widening spread, alright, and heavy volume and sharp acceleration. So a big move at the bottom of multiple waves, and you don't know if it's the bottom, by the way. So all you know is that there are multiple waves, and this one that is below the other waves, and it's bigger than the other waves. It has more volume than the other waves. It has more spread than the other waves. It's obviously going down with great acceleration, meaning if you were to measure this, using a Keltner channel or some type of band-based method, it would see that it's hitting the lower band. If you were to measure this using trend lines, you would see that it's tagging the lower trend line, the oversold trend line, the bottom trend line, the bottom part of the channel, so that's the point. It's a selling climax. So there was a selling climax, and that's what this 1, 2, 3, 4, 5, 6, 7, 8, 9, the bottom here is doing. That's the behavior. It is a selling climax. Now, the volume on the 8th was around 2 million. This increased to 5 million. So if you take the volume on a bar by bar basis, what you're going to notice is one second. There's a lot of volume here. Alright, so over here this is 5 million shares, and it on the 8th, where's the 8th? Well, whatever the 8th is, the point is it's increasing volume. Look at this volume, the next volume, the next volume, the next volume. You see, as price goes down, the volume is increasing, and then you have the heaviest volume on this day. However, the close is high end. So now what he wants to do is dissect the volume. Did the volume come from this close? You see the prior day close right here? Did most of this volume come in from that point to the low, or from the low to the high of the bar? All right, where is this volume distributed? All right, so that's the next point. So he's saying that the whole bar has 5 million volume, Alright, but that's the whole bar, from yesterday's close to that day's low, and from that day's low to the high, and eventually the close. Tape observers would have noted the fact that this heavy volume came from the low on up, meaning most of this juice, most of this 5 million came on or after the low was touched. And this volume came in and pushed price up. This is rallying volume. This is the volume that came in from the low of the day to the close of the day, the low of the day to the high of the day. So, and he says that tape observers know this. The reason they know this is because they're looking at it intraday, right? This is a daily chart, so tape observers are going to be looking at it intraday, and they're going to say, oh shit, the volume is coming in from the low. What does that mean? It means someone is buying the low. That's what it means. And it's not a little, it's a lot. It's 5 million shares, right? Or whatever, 5 million units or whatever. This is what is this? The 50 stocks. So, for example, it would be in the SPY contract, not the contract, the SPY ETF. It may be shares, or in the futures it would be contracts, so on and so forth. All right. So, this fact, what is it telling you? It's telling you tape observers would have noted that the fact that the large volume occurred as the market recorded the extreme low and on the rally from the low. That's where the volume is coming in. This confirms the fact that the climax of the down move, what is this? 1 second. Has been passed. Again, the wording here is really important, if I can get to it. The word confirms. Okay, we are always looking for confirmation. Now, that doesn't mean you have to look for confirmation, but I am. So, when you see him say words like this, confirms, it's important, because the way in my mind, the way I do it, I link it to a high level of probability. And trading is a lot of probability. What is most likely to happen, in the edges and all that. So this confirms. What is this referring to? It's referring to volume off the bottom of that bar. So that volume off the bottom on the climax is confirming that the climax has finished, that it has passed. Okay? So let's talk about it in terms of behavior. What are the behaviors you see? You see, 1, selling climax. 2, volume off the bottom. Sometimes I just call it demand off the low or demand or whatever, but they want to use those terms. The volume off the bottom is confirming that the climax has passed. Okay? The word confirm here is very important. Again, the volume off the bottom on this bar on 5 million shares that came in from its low to its high, it's confirming that the selling climax before it has passed. Wyckoff's words. Right? And gives us the starting point for our next forecast. So once he sees this buying volume come in, he is in his mind saying that the selling climax has ended, and he wants to forecast it. He wants to forecast. He wants to start forecasting. What is he forecasting? He's forecasting direction, the next direction. Okay, and he used the word confirm. Now I'm gonna be paying special attention to this, because these are some of the behaviors that you're going to be looking for and that I currently look for. But I do this stuff intraday, so it's the same. Like, you have trends intraday that follow the same climaxes and all that. Anyway, has already been passed and gives us a starting point for our next forecast. A wave chart would show the details of this tape action, including the feverish activity around the day's low point. Why would it do that? Why would the wave chart show the details of this tape action along with the feverish activity around the day's low? Because a wave chart is an intraday chart. That's why. So an intraday chart would show this feverish activity. If you went to a 5-minute or 10-minute, 15-minute, obviously you'd have more insight into that daily bar. It would show heavy volume. It would show widespread. This bar has the biggest range out of all the bars in the selling climax. So it would show all that. We must now assume, in view of the above, that the trend is up. But this is subject to, again, the word confirmation by the appearance of high support on the next reaction. Alright, so he's used the word confirm 2 times. The first is after the volume off the bottom. Once the volume off the bottom occurred after the climax, selling climax, he used the word confirm, and he said he's looking for the next forecast, and he's saying that it has confirmed what? It has confirmed that the climax has ended. Okay? And we must now assume that the trend is up. Why? Because the climax has occurred and what? And the volume off the bottom. I know I'm repeating a lot of this over and over again, but there's a lot of folks that they won't get it unless you repeat it. So, and I'm one of them. So, anyway, but this is subject to confirmation. Again, a second confirmation by the appearance of higher support on the next reaction. That is, if on the next downswing prices should break through the low, it would be, what would it be? It would be evidence the liquidation was not completed and that support which turned upward has been withdrawn. So at first glance this looks like a contradiction, because up here he's saying, okay, the selling climax has occurred, and now the volume off the bottom has occurred. That's the second major piece of behavior. Based on that, I'm going to assume the trend is up. Assume. Alright? I'm assuming the trend is up. Why? The volume off the bottom after the climax negates the climax. Meaning it not negates, but it confirms the climax has ended, because it's a very strong bullish indication when you have the biggest bar and biggest volume come in. Alright, but now he's saying that as he's looking for a second confirmation. The second confirmation is for a higher low. A higher low. Okay? So now he's looking for a second confirmation. So basically, I know it seems a little, that's like his writing style. You just have to understand what he's doing here. If you see a really strong bar off the low and with a heavy volume, it makes you think that the downtrend has ended and possible uptrend. But he's giving the word confirm again, and what he's saying is that he's looking for a higher low. Okay? So we must now assume, in view of the above, the trend is up, but this is subject to confirmation. Alright? By the appearance of higher support on the next reaction. So if it breaks the low, that means obviously it's gonna go down. So what do what is the learning point here? The learning point is, what are you looking for after a climax? What are some of the behaviors that you're looking for? You're looking for volume off the bottom, or strength off the bottom, or a sign of strength, and you're looking for higher supports, higher lows. That's what he's looking for. Alright? Now this footnote talks about a selling climax. What is a selling climax? I think it's very important to go into this. Why? Because this happens all the time. You can see it all the time on intraday, 5-minute tick, whatever. The phenomenon of the selling climax is caused by panic unloading of stocks by the public. Why? Because of fear and greed and other weak holders, which matched against buying experienced operators, the large interests and sponsors of various stocks, who now see it as excellent opportunity to replace at low price of the stock which they sold higher up. Selling climax, people will sell, and the large interests are going to buy to cover their earlier shorts that they did at higher levels. So, or wish to prevent further demoralization by giving the market temporary support. So sometimes the climax, like, all it's really doing is, it's not the end. It's not the end of the trend. It's just gonna move sideways a little bit and then continue again down. Because as you know, markets don't go straight down. They go down. They consolidate. They down, consolidate, mark down, pull back, rally, pull back, rally, pull back, rally, pull back. All right. So short covering by the bears. All right, for the most. So this could also be short covering. Stocks thus meaning the rally after the climax, could be short covering. So you really want to keep that in mind. But whether it's short covering or not, that's sometimes very difficult to determine. Some people are able to do it. I just look at it from supply and demand perspective and the volume, because anyway, thus stocks become temporarily or more lastingly lodged in strong hands. An abnormal increase in volume is one of the characteristic symptoms of a selling climax. What are the characteristics of a selling climax? One is heavy volume. Since supply and demand must both expand sharply under these conditions, but the supply now is poor and the demand is of good quality, and since the force of supply now will have been exhausted, a technical rally ensues. I think this is what, that automatic rally or something like that they say, this is what he's talking about here. The technical rally or the automatic rally after a climax. Okay? That's what he's talking about here. Where you say, selling climax, automatic rally, secondary test, etc., etc. That sequence. Anyway, if buying on the break was principally for the purpose of supporting prices temporarily and checking a panic or relieving a panic situation, this support stock would be thrown back at the market at the first favorable opportunity, usually on the technical rebound, which customarily follows a selling climax. So that rebound he's talking about is the automatic rally. Okay, and what they're going to do, they're going to sell the automatic rally. Why? Because it gives them favorable prices to sell additional inventory. This and other selling on the rebound may increase supply sufficiently to drive prices through the lows of the climax day and bring about a new decline and a resumption of liquidation. Before I go any further, I just want to say that when you see a sharp acceleration down, don't think that that's a climax that has ended the move, that has ended the trend. It may or may not have ended the trend, and you are looking for confirmation. You're looking for indications. What are those indications? One of them he's talked about is volume off the bottom. The second one he's talked about is a higher low or higher support. All right. Now, what is the other scenario? The other scenario is you have a selling climax, then you have strength. You could have volume off the bottom. You could have an automatic rally. You could have all of that. And guess what? It can resume and continue to sell down because there aren't higher lows. The resumption has continued. So don't for a second think that there is any sequence that is in stone that says if this, then market will go up. If X, Y, and Z happen, market will go up. Okay. Although actually there is a high degree of probability through certain sequences, and I'll touch, when it makes a higher high up here, when it makes a higher low and a higher high on a strong rally, then the probability increases. But I don't want to go into mechanical ABC type approaches. Anyway, on the other hand, should secondary reaction occur after the technical rally above and prices hold higher low or above the climax lows while volume shrinks, we have an indication that liquidation was completed. Now look what he's saying. He's saying after the volume off the bottom, on the pullback, if you have a higher low and lower volume, then we have an indication that liquidation, aka selling, was complete. And support is again coming into the market. Therefore, the market's behavior on these secondary tests, on these secondary reactions, is usually indicative of the next important move. This is the third behavior that he's mentioned that is very important, the secondary test. And he's looking for a secondary test that ideally has a higher low and lower volume. Ideally, secondary test here he wants with a higher low and less volume. So, if you have a climax, expect an automatic rally. Sometimes the rally after the climax will be volume off the bottom or a strong rally, whatever you want to call it. And then after that, the third thing you're looking at is the pullback. And that pullback you're looking for is a secondary test, and you're looking for low volume. So, again, first selling climax. Second is your strong rally, volume off the bottom, whatever you want to call it. But note that this is a strong rally. What else could occur? You could have an automatic rally or a technical rally. In whatever the case is, you're looking for the secondary test, and that secondary test should have lower volume, meaning less liquidation. Okay? In this connection, it should be noted that the same principles which apply to the large swings also apply to the small moves and to the day-to-day buying and selling waves, meaning this happens on the intraday basis. You could use a 5-minute chart and you will see the same thing. And if you see my other videos, I've mentioned climaxes and all of that all the time. The other thing I want to point out is sometimes actually you do have a climax and it does go lower and then it reverses. So although you're looking for a higher low, there are times when it makes a slight lower low and then reverses. That slight lower low is usually in the form of a shortening of the thrust. To me, I've even sometimes it's difficult to say if it's a secondary test or a shortening of the thrust, and I don't know, because sometimes it's a higher low, sometimes it's a slightly lower low, and then you have that reversal up. But in either case, whatever comes after the climax, whether it's a secondary test or a shortening of the thrust lower, it should have low volume. It should have less volume. it should be a weaker downswing than the one before it. By all means, by price, volume, and time, whatever it is that you're using, it should be a weaker. And ideally, you see what happened here. You had a strong selling climax. You had a very strong rally indicated by the follow through bar and 3 green bars. If this were colored, it would be green, green, green. 3 consecutive green bars, all of which are the first of which is on very high volume. The second also is on good volume. And then you have a weak pullback. So strength did come in the form of volume off the bottom. All right. Therefore, a careful examination of your trend charts, group charts, and charts of individual stocks over a period of time will reveal numerous examples of the above phenomena. All he's saying is, hey you, go check your intraday chart. Go check your 5-minute chart. You will see this again and again and again. Alright, it may have slight variations, meaning the climax it will always be a strong wave. Always. Most of the time it'll have the most volume. Almost most of the time. Okay, after that you will get a secondary test most of the time. And that secondary test all the time will be weaker. It may come in the form of a higher low. It may come in the form of a shorting of the thrust. You will also have a strong rally. You may sometimes have an automatic rally which isn't that strong, or you may have a very strong rally with volume off the bottom that looks like a sign of strength. Okay, so he's saying like look for this on a intraday chart and you will see the above phenomenon again and again. I strongly recommend y'all go and do this because it becomes it's the same thing in different forms. You'll see like 2, 3, 4 trends, and the climaxes are there, the sign of strengths are there. You know, even though they look different, they have the same principle. Widespread, heavy volume. Anyway, these will appear on small as well as large scale. That's just, intraday versus daily. However, you must allow for variations. This is not to expect one selling climax to look exactly like the other. That's what I've been saying. The same basic characteristics may be observed, but the time and magnitude of the price and the volume and the extent and sequence of price movements almost invariably differ. For example, the abnormal volume may last 1 or several days. Okay, so you could have one bar with a hell of a lot of volume, or it could be multiple bars with a lot of volume. Or the abnormal volume may precede the recording of the extreme low point 1 or more days. So instead of the lowest bar having the biggest volume, it may be 2 or 3 bars ago that had, the highest volume. So the climax bar, the bar that has a lot of volume, the bar you think is going to end, the bar with the greatest volume, it doesn't necessarily need to be the latest bar. It can be a bar before it. So you have to allow for these variations. By the way, important point to note here. This is one of the reasons why mechanical indicators, they just can't pick up stuff all the time. Because of this reason. They will not pick up climaxes all the time because the volume, if you're looking for heavy volume, on one particular bar, the latest bar or something like that, the variations will not allow the indicator to catch it every time. Okay, and there's a lot of issues. Where, it all boils down to, if you're going to use an indicator, you're going to have to use the indicator and judgment. Because to say that this is a climax just based on an indicator is not enough. and many times it'll be wrong. Okay. Um, so this is where you must use judgment because of this constant variation that he's saying. Be expected, and he's giving examples. Abnormal volume may either last one or several days, or the abnormal volume may precede the last bar or the extreme low. It may be a higher up, or in other words, the climax may be completed in one day or be spread over multiple days, and volume may reach unusual proportions on the day of the low or before the low. Right. Evidence that liquidation was not completed and supported, which turned the market upward on the 17th, has been withdrawn. Okay, so if it broke the low, and I'm not talking about with a shortening of the thrust, I'm talking about clean break and follow through, then you would see that, yeah, this thing is continuing down, liquidation is continuing. As if happened to be the case, the buying support comes in around or at the low, around qualifies, it could be the shortening of the thrust, which goes slightly lower and then reverses, or it could be a higher low, or it could be a double bottom, all right, where the second bottom has much less volume. Happen to be the case, the buying support comes in around this level, we may conclude that demand is beginning to overcome supply. And the next logical development for final confirmation. I'm going to come back to this word. The way we use it and the way Wyckoff used it was a little bit different. All right. He's used confirmation a couple of times. One is after the volume off the bottom, after the selling climax. At that point, he used the word, it confirms that the climax has ended or passed. All right. But then he also said he's looking for a higher low. So it's like one behavior is confirming the next. Okay. But he does make a distinction when he uses the word confirmed. He says confirm, and then final confirmation. Okay. When he uses the word final confirmation, it comes at this point, when it makes a higher high. So he was looking for a selling climax. He's looking for that rally off the bottom with volume. He's looking for higher supports on lesser volume, establishing a last point of support, and then he's looking for a higher high. That higher high with that higher low, with the climax, with the rally, all together, when the higher high is being made, is the quote-unquote final confirmation of what? Of the trend being up. So a lot of times when I was first reading this, it was a little tricky, but here's what you need to know. After the climax, after a strong rally, aka sign of strength, after the pullback, after the sign of strength holds on lower volume, and a higher high is then made, that higher high is the confirmation. Okay, that's what it all boils down to. Anyway, so on January 3rd, these averages rise above 152, which gives the final confirmation. The final confirmation is what we're looking for. Of the upward swing, which may develop into a rise of substantial proportions. Alright, in taking a position, alright, this is really important because this is what everybody keeps asking or looking for, the magic when to take a position. Alright, now you're going to see how Wyckoff did it, and believe me when I say this is going to be different than how you may be thinking he does it. Alright, so let's go into how to take a position. Taking a position in the market. How does he do this? Where would he be going long? The first step is on December 17th. Understand that Wyckoff was a tape reader. He had not only this daily chart but a tape reading chart, and he's looking at it intraday also. So he's very well aware of the rallies and the reactions and this heavy volume coming in right here from the lows. Okay, with that in mind, it'll help you understand why he does what he does. On December 17, when the market gave indications of having completed a selling climax, and at which was what? Which was the heavy volume off the bottom after the climax, after that indication was given, then then he was ready to buy. So let's read this. When the market gave an indication of having completed selling climax, and at the same time, as shown by the entry on our vertical chart for that day, was able to rally vigorously on increasing volume that occurred after the climax, after the selling climax. This was the first time it had shown the ability to rally aggressively, and the first time increasing volume had been shown on an advance of some time in the past. On the basis of these tentative bullish indications, we are justified in establishing a long position if we can get in near enough to the lows so that when we place stop orders on our commitments 2 or 3 points under the purchase prices, our stops will be 1 to 1.5 to 2 points under the danger level. That is the low of the climax day. What does it all mean? It does not mean he's buying the climax. It does not mean that he's buying climaxes. This is another thing that you might hear people say, oh yeah, Wyckoff bought climaxes. He's not buying climaxes. He's buying after an indication that the climax has passed. The bullish indication after that, the first bullish indication that he got was aggressive ability of demand to go up, to rally aggressively with very good volume. He is not buying climaxes. He is buying the demand after the climax that is proving itself because of its ability to rally on good volume. That demand after the climax on an intraday level, is telling him what? Demand is coming in. So therefore he's establishing his long positions. If he can get in as close as possible to the low. So he's not buying a climax on the way down. He's buying strength after the climax on the way up. Okay. The second buy point so that's the first buy point. The second buy point is when the market completes 3 days of lower support, but the close price of each of these days is between 140 and 141, showing selling pressure has lost its force. So the second buy point is when he has an indication that selling is weak on higher supports. If you see the close here, you see the close here, you see the close here, they are clustered. The pullback here, this is for the pullback buyers, by the way. You want to know how to buy a pullback. This is one method on how to buy a pullback. Alright, so it rallies and it pulls back and it starts to not make any more downside progress, and the lows are close to each other and the closes are close to each other, to the point that the closes are not making any significant progress. They are almost the same. The closes are almost the same. So on the pullback, you're looking for the closes to be almost the same, and the inability of the low to continue down. So the 3 bars he's talking about, 1, 2, then 3. You see, it is unable to go any lower on an indication that the thing is not able to go any lower. By the way, some of y'all probably wondering, what about this high volume here? That's actually he doesn't talk about that, but if you do see that, you have to ask yourself, why is this high volume coming in and there's no progress being made on the downside? And it's an inside bar, and there's no progress being made on the close. That is actually a sign of effort. Now, he doesn't talk about that in the study, but if he did, that's what the indication is. But anyway, we're looking at the closes. On the pullback, after numerous bars, you have these final 3 bars here, which have clustered closes. All right. So our next buy opportunity is this: when the market completes 3 days of lower support, but the closes on each of these days are between 140 and 141, showing that the selling pressure has lost its force, since the net result of these selling days, the net result of these 3 days is nothing. What does that mean? It means from close to close, there's no progress. It's not moving. If it's not moving, supply is gone. Okay? That's his logic for entry, because he believes that supply is gone because the net result of the closes is there's no progress in the closes. It's not going down anymore, even after multiple bars. At the same time, lower volume on the reaction. There's lower volume on the reaction, meaning the pullback volume is a low volume pullback. He's looking at all of these bars and seeing, oh, look at the low volume over here. There's a low volume here relative to the rally. The rally has more volume. The pullback has less volume. So you have low volume pullback. The pullback volume is decreasing, and you have clustered closes. It has now appeared that the market has completed a secondary test. So he's buying the secondary test, and which in fact is broadening the zone of support. Okay, it's broadening the zone of support. If the market is not going any lower, what happens? All of these bars, and it's not going any lower, it's going to start to look like it's going sideways. So that is broadening the zone of support, meaning it's creating something like a wedge or a base. Okay, it's starting to move more sideways than it is down. Okay, the low to low to low to low is much less progress. It's more like the closes are not changing and the movement is more sideways. Okay, and on much less volume than the rally. So he's ready to buy on this, and if he didn't buy after the climax, he's ready to buy. If he didn't buy, on the volume of off the bottom on the way up, then he's ready to buy the pullback in this situation because of these indications. We either buy on this reaction if we miss the first opportunity, or add to our holdings. All right, now the third place he's ready to buy. Okay, now the third place he's ready to buy. So that we have one place, the second place is the pullback, and third is the breakout. Okay, so again, if you see people saying he didn't buy breakouts, the evidence is right here. The average goes to new high. New high. What's a new high? Above the prior top. Alright, volume tends to increase on the rally days, an indication that the characteristic of a bullish trend. However, this is least favorable of the three buying opportunities so far, since we would now be purchasing on the wave up, thereby materially increasing our risk, whereas previous commitments were established on the down waves closer to the danger point. Okay, first of all, there's two things. He's buying the breakout, but he's not too crazy about it. Why? Because the stop is far away. But there are benefits on buying the pullback, on buying the breakout, because remember, this is where you had confirmation, the higher high. So you're buying the breakout because it's like you're weighing the risk versus confirmation, final confirmation. If you buy the breakout, you're getting what's known as final confirmation. If you're buying lower than that, you're not getting final confirmation, but you're taking less risk. So that is the trade-off. All right, but all these methods come back to either buying the down wave or the up wave. That's where all these methods are. Whatever behavior you're looking for, it really comes down to two spots: down wave or the up wave. What are you going to buy? All right. So these are the three things. Now, one more thing before I close for today. We covered this much of the uptrend. The other thing is there's actually a fourth place to buy, which Evans describes later, and that is on the pullback after the breakout. So not buying the breakout, but buying the pullback after the breakout. Everyone knows that this is the test of the breakout, or the jump over the creek, and the test of creek. So that's the fourth place to buy. It's not really mentioned here, but I think SMI afterwards they added, maybe it's in another study, he may talk about the test. I don't remember, but y'all know that if you have a higher high or breakout, on good volume, then the other place to buy is on the pullback, on the test of the breakout. And it's very clear that this bar right here, right there, is the breakout bar. It has widespread. Now, it doesn't have big volume. It does have increasing volume, but it doesn't have very large volume. And sometimes breakouts won't have it. The good thing is that it does have widespread, and it has follow through, clean follow through, multiple bar follow through. So when it has that, it's like a jump over the creek, and the test would be right there where the market went as the test of the breakout. So that would be the fourth buy point. All right. So again, I'm just going to sum up some things here before I close. Selling climax came. After the selling climax, you had heavy volume off the bottom. That heavy volume off the bottom, what it told Wyckoff was that the selling climax has passed potentially. All right, he used the word confirmed, but he didn't really mean final confirmation. He just means that was telling him that the selling climax has passed, and it's probably going to rally. All right, it's difficult to explain, but that's what he meant. It rallied, then it pulled back, and what he's looking for on the pullback is less volume and higher support. Okay, around the lows or higher. All right, he got that here. All right, so far his first buy point was on the rally or the volume off the bottom after the climax, and the second point was on the pullback when there is less volume after multiple bars and the closes were tight and they're together, and it shows that selling pressure has abated because there's no progress in the closes. Then after that, the third part was on buying on the up wave, and he bought on the up wave because basically he got confirmation, and this was the final confirmation, the breakout and the higher high. So he was willing to buy the breakout. That's the third buy point, and all of this is in front of you. I'm showing this, not interpreting anything. This is section 7M, page 5. I'm going to stop right here, you know, and feel free to look at and read the course and see if you understand now that I've gone through it. All right, so take care. Have a good day. Bye.